Okay, let's jump right into this analysis. Today, we're unpacking a massive dislocation between what the market thinks is happening and the actual corporate reality. We're looking at a pretty fascinating situation unfolding in commercial real estate, specifically zooming in on Cushman and Wakefield. To really get to the bottom of this, we're going to cross-reference two highly revealing sources: Cushman's meticulously detailed 2026 proxy statement and a recent, hard-hitting quarterly investor commentary from River Water Partners. If you're a focused learner trying to cut through the noise and find the truth behind the headlines, this is exactly the kind of primary source deep dive you need. So let's just tackle the elephant in the room right off the bat. If you've been watching the markets at all lately, you know that fears of artificial intelligence and algorithms totally replacing human brokers have sparked some truly indiscriminate selling in commercial real estate stocks. The prevailing narrative out there right now is that the traditional service provider is practically obsolete. But is that actually true? Well, this single question is essentially driving the entire valuation of companies like Cushman and Wakefield today. Now, look at this stark contrast between the overarching market panic and the view of seasoned investors on the ground. On one side, you have the market fear, this widespread idea that tech platforms will completely disintermediate traditional firms. But on the other side, we have the River Water Partners thesis. They argue that this fear is way overblown. Their take is that AI simply cannot replace the bespoke, relationship-driven expertise, that hyper-nuanced local market knowledge, and the hard-nosed negotiation skills that actually drive the highest value deals. In their view, AI is a fantastic tool that augments the human element. It definitely doesn't replace it. Section 1. The Cushman and Wakefield moat. Let's look at the actual foundation of the company to see if those AI fears hold any water. Here is the number that really matters: 53%. More than half of Cushman & Wakefield's fee revenue comes from recurring contract-based property, facilities, and project management. We aren't talking about brokers out there hunting for single lease agreements every day. This is an annuity-like business locked in through multi-year contracts. What that gives them is massive earnings visibility and an incredibly stable baseline of cash flow that a generic algorithm simply can't disrupt overnight. And Riverwater points out that this competitive moat goes even deeper. Think about it. Shifting mission-critical, multi-million-dollar real estate portfolios over to an untested algorithm, that's just not something institutional investors are going to take lightly. The barriers to entry here are absolutely formidable. We're talking about over a century of built-up brand reputation, incredibly strict global regulatory compliance, and deeply entrenched broker networks. These are client relationships that heavily favor the incumbents, making the switching costs incredibly high. Part 2, inside the proxy statement. Let's peek under the hood of their 2026 filing to see how leadership is actually steering the ship. Take a look at CEO Michelle Mackey's letter to shareholders because it perfectly captures their internal mindset. She explicitly notes that they are motivated by the desire to solve complex problems. She states that, now more than ever, complexity is just the norm. They pride themselves on sitting right at the intersection of outthinking and outdoing. And really, this is exactly why clients need bespoke human advisory rather than generic software. The problems they're tackling are incredibly complex and constantly shifting. Section 3. Paying for growth performance. Because to truly understand a company's strategy, you have to follow the money and look at how its executives are actually paid. Check out how leadership incentives have fundamentally evolved here. Back in the post-pandemic survival years of 2023 and 2024, compensation metrics were strictly defense-oriented, focused on strategic cost efficiency and adjusted free cash flow. But look at 2025. There is a hard, very deliberate pivot. The Compensation Committee shifted the primary metric to adjusted earnings per share, or EPS. That signals a massive internal shift from cost-cutting defense right into a very aggressive, growth-oriented offense. This scorecard right here cuts through all that dense proxy jargon to show the clear results of their previous performance cycle. The executives absolutely crushed those defensive goals. They hit 200% of their target for adjusted free cash flow and over 156% for strategic cost efficiency. All that resulted in a massive 178% aggregate payout. So what does this tell us? It tells us this management team has proven their operational discipline. They literally do exactly what they're incentivized to do. But here's the kicker. It doesn't just stop with hitting internal targets. Leadership only gets their full reward if they actually outperform the broader market. The proxy outlines a relative total shareholder return, or TSR modifier. Basically, their payout gets adjusted up or down by 20% based on how the stock performs against the Russell 2000 over a 3-year period. During the last cycle, they hit the 64th percentile, ensuring their financial interests are locked in perfectly with yours as a shareholder. Section 4. Future targets and deleveraging. Now that we know they have a disciplined foundation, let's look at the roadmap to 2028. If you're an investor, these are the targets you're going to obsess over. This is the financial framework they laid out at their investor day. They are targeting 6 to 8% organic fee revenue growth, a massive 15 to 20% annual adjusted EPS growth, and they plan to bring net leverage down to 2 times by the end of 2028. Make no mistake, this is a clear, highly aggressive roadmap for double-digit earnings growth and strict balance sheet management. And you can see that aggressive roadmap play out right here with a huge acceleration in their cash-generating power. They went from $167 million in free cash flow in 2024 to a projected $293 million in 2025. Riding that momentum, they are setting the stage to bank an estimated $800 million in cumulative free cash flow over the next cycle through 2028. And remember, they're not just sitting on this. They already used some of this cash to prepay $300 million of debt in 2025 alone. Finally, bringing it all together, the contrarian opportunity. How do we synthesize all this data? This is your classic contrarian setup. The market perception is that this is a highly vulnerable business, trading at a steep discount to its historical valuation and its peers, mostly due to AI anxiety. But the reality, mathematically backed by the proxy statement and financial filings, is that this is a cash-generating machine. It has a massive 53% recurring revenue mode, it's aggressively paying down debt, and management is hyper-aligned with shareholders to drive real earnings growth. So I'm going to leave you with this final thought to chew on as we wrap up this explainer. Look at the hard facts, look at the recurring revenue, and look at the executive alignment. Are the algorithms actually replacing seasoned commercial real estate brokers who handle complex multinational portfolios, or is this AI anxiety just creating a highly lucrative temporary mispricing for the savvy, patient investor? Thanks for diving into the data with me today.